Good evening and welcome to the Money Show, the place where money stops being confusing and starts working for you. Because let's face it, every decision we make, from the coffee we buy in the morning to home we dream of owning, from planning our next holiday to securing our children's future, has one thing in common: money. Yet, despite the role it plays in every chapter of our lives, very few of us were ever taught how to manage it, grow it, and make smarter financial decisions. That's where we come in. Whether you're just starting your financial journey, building wealth, investing for the future, planning your retirement, or simply trying to make your salary stretch a little further, this is your show. Every day we'll cut through the jargon and the noise to bring you practical advice, expert insights, smart investment ideas, tax saving strategies, market trends that actually matter, and real stories from people who've transformed their financial lives. No complicated spreadsheets, no intimidating financial language, just clear, honest conversation about the decisions that can help you build a stronger financial future. Because personal finance isn't just about numbers. So let's begin the show. And I'm Kavita Thapliyal, and let's just flash our WhatsApp number quickly on the screen, because that's the number through which you can get in touch with us. This is the show where we also do your life financial planning. Send across your questions, and the email ID, themoneyshow@etnow.tv. You can reach out with all your financial or investment details, and we will help you achieve all your financial goals. All right, so let's begin the show, and we have Nasreen Mamaji as our expert on the show, who will be talking about investment strategies, definitely, and also will be answering your portfolio-related queries. Nasreen, hi, good evening, and welcome to the show. Nasreen, we'll start with our viewer queries first, and later on we'll talk about the most important topic today, which is how to book your profits, or when to book your profits on your investments. But let's begin. Let's take Ashish's question first. This is via email. He's from Bangalore. Investing almost 78,000 a month, and he's built a diversified portfolio for himself. It's almost 41 lakhs. That's the latest value of his portfolio. And he wants to build 7 CR in some next 12 years, and which is why he wants your advice and whether it's achievable or not. He started a momentum index fund for his 1-year-old daughter. Okay, so I have a couple of funds in terms of details that he's given us. MOSL Nifty 500 Momentum 50 Index, SBI Small Cap, SBI Contra, Parag Parikh Flexi Cap, Kotak Emerging Equity, Canara Robeco Blue Chip, NTPC Direct Equity, and he's talking about having Geo Financials also Direct Equity Fund. Okay, so those are the stocks that he's having, NTPC and Geo Finance. Okay, but let's just look at mutual funds, and also let's give him a strategy to achieve 7 CR in next 12 years. Okay, Nasreen?
So basically, Ashish, I think your portfolio is really very well diversified. You have large cap, you have flexi cap, you have mid cap, small cap, and you've also introduced the factor investing. So your first question is, is investing in the Nifty 50 Momentum 500 50 Index Fund for your daughter a good approach? So yes, that it is a good approach at the 15 to 18-year horizon. A factor index like momentum can add value, but a word of caution is be the only investment, and you can combine it with a broader market like, say, the Nifty 50 or the Nifty 500 Index Fund.
Okay. All right, I think there is some technical issue, but then let's look at Ashish's planning. So definitely he needs to continue the investments and minor changes that, Nasreen, that you were recommending. He definitely needs to step up his SIP, because the current amount is good, but then if he wants to achieve 7 CR in 12 years, he needs to step it up. As and when, definitely recommended, Ashish, but almost 18 to 20% is what Nasreen is recommending you to step up. You can do it in one go if that's doable for you, but if not, as and when. The ideal figure to step up and to achieve 7 CR is almost 18 to 20% of increase in your SIP amount. So be careful of that. The funds so far look good, but then yes, momentum fund is suitable as a satellite allocation. That is what Nasreen is telling us. Also, what happens is important for you to have a core portfolio which is well diversified. And in your case, Ashish, the good news is that it is very well diversified. You've got funds of good pedigree, good AMC, and good track record as well. But momentum fund as an addition is more of a satellite allocation in your portfolio. So you can go ahead with that. But then, yes, your daughter's portfolio, you can limit it to almost 15 to 20% because that is what your query is. You have added this particular fund, the momentum fund, for your daughter education or maybe the future goals for your daughter. But your portfolio should not be just one goal oriented. I'm sure you must be having a lot of other goals. Better future for your daughter, because you're investing, has to be one of those goals. So maybe a bucket strategy will be good for you. So you can have certain aspect of your investment, a markdown for your daughter's future or maybe her education goal, if that is what is on your mind, because she's just 1 year old. But having said that, you also need to think about your retirement and any other financial goals, which could be long term or short term, because that's the benefit of having the right financial strategy. It's important for you to mark down all your financial goals, be it long duration or short duration. The right financial planning can help you achieve all of those goals. So way to go. Step up. 18 to 20% of your SIP, that's the recommendation coming in. And also minor changes in your portfolio recommended. So far, these funds in your portfolio are a thumbs up from Nasreen. But let's move on. We have our next viewer on the phone line. This is Mukund talking to us. Mukund, hi, good evening. How are you?
Good evening, ma'am. I am good, ma'am.
All right. Mukund, you have sent us some details. Do you want to read out your question to us?
मैं जस्ट जो मैंने पोर्टफोलियो आपको भेजा था उसमें मेरे को ये जानना था मैडम कि मल्टी कैप मेरे पास था तो उसके अगेंस्ट में स्मॉल कैप, मिड कैप, फ्लेक्सी कैप तीनों थे मेरे पास.
All right, Mukund, I will just read out your portfolio. I will just read it out and you check details are good or not. So you have two sons and basically you have done your financial planning or you have made this portfolio for their education, 6 and 9 year old. So child education is your goal, home purchase, retirement is also your goal. You're investing almost 42,000 per month to SIPs. And the investments in your portfolio are Parag Parikh Flexi Cap 5,000 rupees, MOSL Large and Mid Cap 5,000, HDFC Mid Cap 5,000, Invesco Small Cap, Kotak Multi Cap, ICICI Multi Asset, Edelweiss, Gold and Silver Fund of Fund, and you also have Nippon Nifty 50 ETF. Is that right?
Yes, sir.
Okay. You also have a satellite portfolio. SBI PSU Fund, Nippon Value, Tata Digital India. That is, what is satellite SIP? The total amount of SIP going on. Okay, got it. 9,000 is the total satellite portfolio SIP going on. Okay, very impressive, Mukund, because, to the previous caller, we were just helping him understand what is a core portfolio and what's a satellite portfolio. So congratulations over there. But Mukund, very important thing, a very important question. I need clarity from you. How much time are you giving for your child education goal? What's the corpus for that? Home purchase, how much time? What's the corpus? Retirement, how much time? What's the corpus? Let's start with child education. Mukund?
Year for child education and after 10 year home and 18 after 18 year retirement.
Okay.
18 to 20 year, yes.
Okay, 1 second. So let's give different years. Okay, after 18 years retirement. How much is the corpus that you need for retirement?
Minimum 3 crore, 2 to 3 crore.
3 CR for retirement. Okay.
Yes.
Home purchase after how many years and how much do you need?
After 10 years, 1 crore.
After 10 years, 1 CR. And for child education, because you have two sons, 6 and 9, right? So what is the duration? How much would you need?
I think 9 years. After 9 years, 50 lakhs.
Okay.
Yes.
And after 12 years?
Yes. After 12 years, 50 lakhs.
Okay, so both the kids, 50 lakh for education, home purchase after 10 years, 1 CR, and retirement after 18 years, 3 CR. All right, Nasreen, I think you are back with us. How can you help Mukund?
Okay, so this is actually a very thoughtfully constructed portfolio,
Right.
Mukund, and you have flexi cap, you have large and mid, you have mid cap, small cap, multi asset, gold, and the Nifty 50 ETF. So pretty much a good diversification. There is clearly some overlap in the Motilal large and mid cap fund, HDFC mid cap fund, and Kotak multi cap. So you can trim that down a bit and just have one out of the three. Also, the Nippon Nifty 50 ETF overlaps partially with your large cap allocation of your actively managed funds. So there again, you can take a call between the ETF and the active funds. In your satellite portfolio, you have a PSU fund, you have a digital fund, and you have the Nippon Value Fund. So these are basically lifestyle or kind of, a theme allocations. Keep the total satellite allocation above about 15% of your portfolio. So in the core portfolio, you're investing 33,000 a month. In the satellite, you're investing 9,000. Your total SIP is about 42,000 a month. And you're also doing PPF 5,000 and EPF 2,300 per month. So, keeping in mind all your current assets, which is mutual funds, about 3.2 lakh, you have shares of 6 lakh, you have EPF 6 lakh, PPF 5 lakh, and NSC 1 lakh. So, your first goal of 50 lakh for the child's education in about 10 years at about 12% compounded annualized growth rate of 42%, monthly, along with, your other current values of your other investments, you could be reaching about 95 to 97 lakhs, so say about a crore. So what you need to do is, you need to kind of diversify between these three goals because you have two children, plus you want to do the home purchase. So for your home purchase, you have also got that goal for about 10 years away. So, you need to, maintain discipline and also do a step up SIP because, you have three goals all requiring about 2 crores, 50 lakhs each for the child, for the two children and your home purchase. And so you might find it a little difficult to manage all the goals because later on, you need also 3 crores for your own retirement.
Mhm.
So you also have for this, you can use the balance corpus and the EPF and PPF SIPs that you're doing. So this you get about, 5 to 6 crores in 18 years, assuming 12% equity returns and your current EPF, PPF balances and your,
All right.
continuing investments.
Okay.
So this will exceed the 3 crore target that you have set yourself
Okay.
between the two children's education and the
Mm-hmm.
home loan.
All right, Nasreen. I
So
think
the
Mukund.
overall assessment is that you will be able to meet all the targets, and around 5 to 6 crores is your expected targets in about at the end of 18 years.
Okay, so that's good news for Mukund, and all the best. Keep investing, and as and when, try and step up your investment. But with that, it's time for a short break also. But post that, we'll be talking about something very important. When should you decide that it's time to book profit on your investment? And also, today is our senior citizen special. So, how should you consider insurance pension plans? That's right. This is the discussion after this break. Welcome back. And one of the most common question every investor is asking or usually asks us is, I have made good returns. Should I book profits now? The answer isn't as simple as a yes or no. In fact, one of the biggest mistake investors make is booking profits based on emotions, whether it's because the market is at an all-time high, they've earned a decent return, or they are afraid of upcoming correction. Successful investing isn't about predicting what the market will do tomorrow. It's about making decisions based on your financial goals, asset allocation, the quality of your investment. So when should you actually book profits? And more importantly, when should you stay invested? Let's break this down with Nasreen Mamaji. Nasreen, hi, welcome back. Okay, what's the strategy to book profits?
So, you can book profits only if there's a valid financial reason and not simply because the market has recovered, actually. So, you should be booking profits based on your goals, your asset allocation, valuation, and portfolio concentration rather than market. When should you book profits? That's a very, very important question. When your asset allocation has changed. That's, reason number one. if your target allocation is equity 70% and debt 30%, then after a strong rally, it becomes equity 83% and debt 18%. That's a good time to rebalance by booking some profits from equity and moving them to debt or other asset classes. If you're approaching a financial goal, that's another very good reason to rebalance and book your profits. So if you're within 2 to 3 years of a goal, such as buying a house, child education, your retirement, you can gradually shift money into safer investments, like a short duration debt fund, a banking NPS with debt fund, or FD, so that you can protect your corpus. Then another reason could be, a sector has become too large. So that's also one of the reasons why you might be wanting to book a profit, because if it's grown disproportionately on your books and it starts to dominate your portfolio, then that's the time that partial profit booking could help. When should you not book profits? I think that's an easier one to follow. Simply because the markets are at all-time high, because you've already earned a good return in your mind, out of fear that the market will correct, or because you are chasing the next hot sector. So, it's very difficult for investor to be able to manage all these differing kind of fears. So don't just follow, blindly that you need to book a profit. Also,
In the
there could be,
entire portfolio, Nasreen, it's very important to also identify from where to book profit. If we have to just talk about equity, people invest
right,
in direct equity, people invest to mutual funds. In debt, they
right,
have a lot of fixed income investments also. So how can we
right.
decide from where to book profit first?
See, for mutual funds, the fund managers are already buying and selling securities at the
Right.
back end within the portfolio based on the valuations and opportunities. Now, as an investor, if you also start doing it, it's not really necessary unless your goal or your allocation is demanding it, So you shouldn't be doing and repeating what your fund manager is already doing. But if for a direct equity investor, regular review is very important. So you can exit a company where the investment thesis has changed, the valuations become excessive, or the business fundamentals have deteriorated. So that's a call that a direct equity investor needs to take themselves. But also you have to look at tax considerations, because just by booking profits, you're also paying tax. So is the
Right.
whole exercise worth it? That is something that we really need to ask ourselves.
But then,
So
but then, should you take the decision to book profit based on the tax treatment of the investment?
So, what you can do is you can stagger, the profit booking. Like if you've met your goal or you need the funds for a particular reason, then you can also stagger it over a couple of financial years so that you can take the benefit of long-term capital gains for equity mutual funds to the extent of 1,25,000 per year. You can also, that's one of the reasons that you should be looking at the tax considerations, the short-term and the long-term capital gains. What are you liable for? And if you feel that the gains are not even commensurate with your capital gains tax, then don't
Okay.
even bother. So keep this in mind.
So
Will
one
the
quick question,
post-tax,
Nisreen. So one quick question, Nisreen. Should you be
yeah.
exiting or booking profit to rebalance the portfolio or to just, square off the gains?
So as I mentioned earlier, if you have a target of say 80-20 in your portfolio, 80%
Okay, perfect.
equity, and so that I've already answered that on a little earlier basis.
Right.
So you can definitely do that. So will the post-tax proceeds actually improve your financial position? The bottom line, you should be answering that question. So the key takeaway, Kavita, is book profits to rebalance your portfolio and not to predict market. Wealth is created by actually staying invested. And while wealth is also protected through, staying invested and not always looking at market timing. So time in
Absolutely.
the market and not market timing. That would
Okay.
be what I would like to end with. Yeah.
All right, fantastic, Nasreen. Thank you so much, as
Thank you.
always, for being a part of this show and helping our viewers with their financial decisions. Thank you.
My pleasure. Thank you.
But for our viewers, it's time to switch focus on our senior citizens special. So this is specially for our 60 plus viewers. Picture this. You have worked hard for 30 long years. You finally get your hands on your retirement lump sum. Right on cue, an insurance agent calls you. They promise you a guaranteed income for life. Sounds like perfect, stress-free dream, isn't it? But Just wait before you sign on that dotted line. Today, we are cracking open the real truth about insurance pension plans. Are they reliable safety net for your golden years, or are they a slow burning trap for your wealth? So let's break it down. First, the hidden cost of safety. Let's address this biggest elephant in the room first. For most smart investors, traditional insurance pension plans are a bad deal. Why? Some brutal truth of facts. First, low returns. They usually give you 5.5 to 7.5% interest. Now, in the real world, that fails to beat inflation. Your money actually loses purchasing power over time. Second, the tax trap. Every single rupee you get as a monthly pension is fully taxable based on your regular income slab. Third, zero flexibility. Your money is locked in a tight vault. If you face a sudden medical emergency, you cannot just withdraw your cash without facing heavy penalties, which you definitely don't want. But there is some good news. The good news is that you can plan, or this can actually be good for very specific type of people. If you are someone who hates market volatility and wants absolute peace of mind, then this is for you. Lifetime lock-in, like bank FDs only lock your interest rate for 5 to 10 years. An immediate annuity plan locks your rate for life. Now, even if market interest rates crash down to 3% in the future, your payout stays exactly the same. Forced discipline, it's perfect. In fact, it stops you from overspending your retirement corpus all at once, converting a vulnerable lump sum into a steady monthly drip. Smart alternatives versus pension plans. So what should you do now? Do not just blindly hand your money to any insurance company. Follow these 3-step strategy. Step 1, max out superior government options first. Think of the senior citizen savings scheme, or that gives currently massive 8.2% secured return. Step 2 would be, if you do want an insurance plan, choose an immediate annuity plan and skip the deferred plans where you pay premiums for years and put down a lump sum at retirement for instant cash flow. Step 3, always choose the return of premium option. It ensures that your time, your hard-earned principal goes back safely to your children, not the insurance company. And in the end of the day, retirement is all about comfort. It's not about complexities. Buy a pension plan for guaranteed peace of mind, but do not look at it as a wealth builder. So that's it on our very special segment for senior citizen. But before I wind up this particular show today, let me just leave you with something very important again on investments. The Nifty 50 is India's most tracked equity benchmark. But equal weight indices offer a different way to invest by assigning equal weight to every constituent, enabling broader diversification. Now, to help us understand how these indices work and who they are best suited for, we are joined by Divya Menon, Head Product, Axis AMC. Let's listen in.
I'm now joined by Divya Menon. She's the Head of Products at Axis AMC. Divya, thank you for joining us today. Firstly, I want to ask you about equal weight indices Nifty 50. And let's start off with the basics. What exactly is the Nifty 50 equal weight index and how exactly does it work?
Thank you, Ashish, for having me here. Ashish, like the name suggests, right? It's equal weight index. It's there in the name. Essentially, this index offers equal weight opportunities, equal opportunities to all the stocks. So what happens in traditional, say a Nifty 50 index is the weightages of the stocks are dependent on the market cap of each stock. So the larger the company, larger the market cap, larger the weight. But in equal weight index, it does not take into effect the size of the company. Every individual company has the same weight, which because this is a 50 stock index, it will be at 2%. So a Nifty 50 versus a Nifty 50 equal weight index, it's the same 50 stock, but the difference lies in how are you going to weigh the stocks. In Nifty 50, the top 10 stocks have 50%, more than 50% weight, whereas in equal weight, the top 10 stocks are capped at 20% weight.
Right.
So the way the equal weight index is constructed is essentially by taking the 50 stocks, same as those in Nifty 50 index, giving each stock a 2% weight, quarterly rebalancing the weight, which means if the stock at the end of a quarter is more than 2%, there is profit booking and it is trimmed down back to 2%. If some stock weightage is less than 2%, it is brought up to 2%. So there's a quarterly rebalancing happening. And every half year, we know that Nifty 50 index, the constituents are reviewed and modified. If required, the same constituent list then flows into the Nifty 50 equal weight also. So essentially, it's a smarter way of looking at the Nifty 50 index.
Right, so you're making a lot of points about these equal weight indices. Now, the follow-up question would be, can these equal weight indices actually help reduce concentration risk in a portfolio, which we see so often?
Absolutely, absolutely. I think both in terms of stocks, in terms of sectors, and equal weight index can reduce your concentration risk. So let me give you an example. The top 10 stocks in Nifty 50 today have more than 50% weight, 54-ish type of weight. But top 10 stock in Nifty 50 equal weight will have only 20% weight. Whereas the bottom 10 stocks in Nifty 50 has 6%, around 6% weight, which is very, very nominal. But the same bottom 10 stocks in an equal weight will have 20%. So whether it is bottom 10 or top 10, you have a decent allocation, decent diversification, and therefore lower concentration risk in an equal weight index. That's in terms of stocks. But if I were to talk in terms of sectors, so financial services sector, as you know, is the largest sector in Nifty 50, which has more around 35% weight currently. But the same sector will have lower, around 20-22% weight in the equal weight index. Similarly, a sector like healthcare, which has only 5% representation in Nifty 50, has 10% representation in an equal weight index. So which essentially is showing you, right, the concentration risk is lower, the diversification is higher.
And who exactly should consider investing in a Nifty 50 equal weight index and why?
Essentially, this is an equity index. So obviously, I don't have to state this, but only a long-term investor should look at investing in an equal weight index. But like I said, if you are looking for true diversification, lower concentration, you want to be in the large cap space, but you don't want all or bulk of your money to be in the mega cap, large caps, but a broad-based investing, then Nifty equal weight is for you.
Right.
Anybody who wants a disciplined investment and is seeking better opportunities or better way of allocating in a large cap space, for them this index, equal weight index, is a suitable play.
All right, thank you so much, Divya, for your time and for talking to us today on this important topic. Thank you so much.